I think what you're seeing, and this is my interpretation, so clearly there's a health warning involved in this, but I think what you've got going on is a division between, if you like, financial stability policy and conventional economic policy. And I would suggest that what the central banks are doing is they're using their balance sheet, in other words, liquidity, for financial stability reasons, and they're going to use interest rates to try and control the inflation problem. Now, what that means is that you're likely to see interest rates higher for longer, maybe rather than higher and higher, right? So I think they stay up and they plateau for a long time. So I don't think we go back to the very low interest rate regime for some time. But I think the balance sheet is a very different vehicle, and that will be used opportunistically when necessary to basically improve liquidity in financial markets. Now, I think that the liquidity in financial markets has already got down to dangerously low levels, which is, I think, what you're seeing in the sovereign bond markets. Okay, and as I've said before, this is a red light for central banks and treasury ministers around the world. They do not want the sovereign debt markets to be derailed at all costs, right? So if that happens, inflation fighting is off the table. They'll focus on the sovereign debt markets without any question. Now, I think we're close to that point. I think that's what the Federal Reserve is basically engaged in looking at. Now they want to improve the integrity of these markets, and therefore they're going to use their balance sheet more and more. Now, if they don't, if we're wrong, it's possible, entirely possible we're wrong, and you get further QT, okay, in other words, significant balance sheet shrinkage, alongside higher interest rates. So there's a real danger of seeing another episode of a refinancing crisis. Now, one's got to think about what's happening in financial markets with that, with that backdrop. If you pick up an economics textbook, what it tells you is that what finance is all about is interest rates. Okay, that used to be the case, and it's certainly the case if the financial markets are operating as new financing mechanisms. In other words, that you're a corporation or a business, you want to raise new capital, you come to the financial market. What really matters for you is the interest rate you pay, okay? Because you will compare that against your expected profit rate. And if the interest cost is less, then you may well borrow to expand. Fair enough, okay? The trouble is that that's not the world we live in anymore. Okay, there's not very much capex going on. Most of the capex that is going on is occurring in the East, in China or Asian markets. In the West, we've had very little capex for the last couple of decades. The only capex that's going on is really replacement stuff, which doesn't really, interest rates are not really the question there. What the financial markets have turned into instead is not new financing mechanisms, but refinancing mechanisms, refinancing this whopping great debt load that we're sitting on. Now, how do we get down this road? How do we make this big error of taking on so much debt? I think it's very simple that the central banks made a big error 20 years ago. And what they basically did was, first of all, or what the policymakers, let's say, first of all did, is they let China into the World Trade Organization without any controls. So China exploited this to its advantage. It created, and let's say, in truth, to our advantage initially, it created cost deflation because costs were very low in China, and it could dump a lot of goods into the world markets at very low prices. So needless to say, you got a deflationary hit to the price level in the West, and what that caused was falling inflation rates. Now, the central banks worried about this because they thought what we're looking at here is falling high street inflation, but it's actually a monetary deflation. And we as central bankers should be fighting monetary deflation because we know from history in the 1930s, it was hugely damaging. So they misread it. It wasn't monetary deflation, it was cost deflation, right? And they'd ignored the supply side effects of allowing China to come into the world economy. So what they did is they cut interest rates. They shouldn't have done that, but they did. They cut interest rates. What do interest rates do? They incentivize us all to take on more debt. And so as interest rates started to drop, more and more debt was accumulated. Now, the problem with debt is that it's a dead weight on economic activity, and it tends to crowd out productive investment. So the more debt there was, the slower the underlying productivity of economies and the slower the growth rates, which meant the central banks were even more enthusiastic about cutting interest rates more. And so you got this vicious cycle of this huge debt load. Today, there is $350 trillion worth of debt in the world economy, right? With an average lifetime of 5 years, which means that, simple maths, $70 trillion of debt has to be refinanced every year. So what you've got, or what you have to have, is balance sheet capacity to do that. You've got to be able to roll over the debt position, the new debt, to get new debt to replace the 70 trillion that's maturing. So you need liquidity and balance sheet space. The only way you get that is by the central banks creating liquidity and providing the means to expand the financial sector balance sheet within each economy. Now, if you draw a comparison, that 70 trillion compares with 10 trillion of new capital financing in the world economy. So financial markets are 7-to-1 refinancing over new financing. And that's what the central banks don't understand. That's what the textbooks never tell you. And that's the reality. In a world where you've got refinancing, liquidity is critical. If that liquidity is missing, you will get refinancing crises. Look back over the last 2 decades, every financial crisis you've seen has been a refinancing crisis. And we're going to get more if the central banks don't wake up.